Hey everyone, welcome to another episode of Mayhem's Macro Monday on October 3rd, 2022. We're going to talk about some of the charts I shared on my Twitter feed, Mayhem for Markets, that were the most popular and why I think they're important. So without further ado, let's get started. The first chart here is a chart of the wipeout that we've seen in wealth. U.S. equity and fixed income markets hemorrhaged $57.8 trillion so far this year. That is, I believe, the worst that we've ever seen on record, and it certainly is a staggering amount of money. Most of us can't even imagine $1 trillion, and we're talking about $57.8 trillion. The reason for this is multifaceted. First, we have high degree of inflation that seems persistent. We have recessionary economic forces that are causing some degree of consternation among investors. And we have a very, very aggressive Fed as well as other central banks that seem dead set on applying increasing tightening pressure to a variety of different markets. So why does this matter? Because we're not out of the woods yet. While we've seen this record drawdown, it doesn't mean that the worst is behind us. I know that a lot of folks are hoping that the end is sooner than it may actually be. But as long as the Fed and other central banks around the world are tightening, they're removing liquidity from financial markets. They're doing everything that they absolutely can to try to subdue inflation with the limited tools they have that are focused solely on demand in a world that's facing inflation that's coming from a variety of pressures, to include supply chain constraints that are still persisting. So it's reasonable to say that at this point, we're not out of the woods yet. We've got more room for this market to continue to roll over. And that's something that's going to be an ongoing theme unless and until the Fed really does pivot. And probably also until we see a larger sell-off by retail of their holdings. And I know you're retail, I'm retail. Most of the people listening to this are retail. I'm not trying to say anything against us, but we own too many stocks. The amount of stocks that retail owns versus a percentage of their net worth is the highest it's ever been in history. And that's just another sign, because typically during bear markets, one of the other elements that happens is sort of a capitulation where folks like us are selling out of our stocks that are held in taxable accounts or even in retirement accounts. Some folks cashing out 401ks. This is the cycle, the emotional extreme, the wipeout. We haven't quite gotten there yet. However, as you may have seen in my recent article that was discussing why we may see a pop, which seems to be happening today. It was an article published on TraderAid.com. We have seen retail begin to sell some of those holdings. A strong dollar really hurts a lot of companies, particularly those that are doing more business overseas, a lot of technology companies, export-centric companies. We can see as the dollar has risen, those companies have been hurt more. They're also the same companies that are citing during their earnings calls what they call Forex headwinds, or essentially the fact that the dollar is so strong that it's actually starting to cause them material harm in their revenues, in their earnings. So I think it's something that we should be keeping an eye on, because as long as the Fed is tightening more aggressively than central banks like the European Central Bank, like the Bank of England, which seems to have started its own pivot, like the Bank of Canada, like the Bank of Japan, which seems to be in a cycle of never-ending easing, as long as that's continuing with our major currency pairs out there, the dollar is going to continue to have the path of least resistance being higher, like rates. So it's something that we should definitely be keeping an eye on, because there is a strong correlation between central banks that are more hawkish, higher rates, and relative strength in an economy, which we have versus Europe, versus England, versus some of these other economies. That drives the currency higher. And so that is causing a lot more pressure. You can see that S&P 500 companies with more U.S. revenue exposure only declined 9.9%. Whereas those that have a more heavy foreign revenue exposure declined 20.7%. This chart goes back to what I was discussing a little bit earlier. Don't fight the Fed. This is something that I keep talking about on Twitter, on TraderAid, and elsewhere. And the reason for it is that throughout history, no one has been well served fighting the Fed. When the Fed is easing, it makes more sense to be getting more long risk assets. There's obviously going to be fits and starts with any bull market that climbs the wall of worry, but the path of least resistance for risk assets, for bonds, for real estate tends to be higher during an easing environment. We are no longer in an easing environment. We are now in a pretty unforgiving, tightening environment. What does that mean for us as investors and traders? It means we don't fight the Fed on the other side of the coin. If the Fed is tightening, then that means risk off. It's a good time for me, at least, to raise cash, to look at selling rallies and shorting them, and to be basically on the same side as the Fed's policy framework. The Fed wants to destroy wealth. The Fed wants to slow the economy. Who am I to get in the way of that? Who am I to say I'm smarter than the market or I'm more powerful than the Fed? So I will just go with the path of least resistance, which means I'm not fighting the Fed. And I think it's wise for everyone out there who's watching this to consider that same, because you can see here on this chart, the previous 6 bear markets saw a bottom arriving amid Fed cuts. That's important. That's a really key thing to take into consideration. So for me, as an investor and as an active trader, I pay very close attention to the Federal Reserve, because over the last several market cycles, they've only become more and more important, setting the appetite for risk. Consumers are in big trouble. We're seeing enormous amounts of debt. No small part of that is being accrued to try to fight against inflation. So with rates rising, that same debt is becoming more expensive to maintain, and that's putting even more pressure on consumers that were trying to fight off the rising cost at the grocery store, at the gas station, the utility bills, property taxes if they're homeowners, rent if they're not. All these things have been climbing and climbing and climbing. All the costs that consumers accrue. And other things as well, like healthcare costs, have been rising as well, and typically rise at least twice the rate of inflation. So consumers are in big trouble, because as rates rise with this big debt load, it's likely we're going to see more defaults. It's likely also we're going to see greater socioeconomic consequences. People are going to be losing their homes. Unfortunately, we're seeing a lot of folks that are unable to pay their rent, unable to pay their utility bills. These are things that you don't want to miss paying on unless you absolutely have to, unless you're in dire distress. I believe the number of folks that are facing eviction is 3 to 4 million at this point. And that doesn't sound like a very large number, but remember, those are mostly family units. So it's more than one person in a lot of those evictions. And we have a fair number of homeowners that are also facing foreclosure. It's nothing like the great financial crisis, and I don't think it's going to get that bad, because we have a completely different environment in the U.S. We have a lot less adjustable rate mortgage exposure here. But in other countries around the world, that's not the case. When you look at England, for example, I believe it's close to 20% of their mortgages are ARMs. And New Zealand, Australia, Canada, and otherwise are not terribly different. So while we might not see that same pressure in the housing market here, housing prices have gotten extraordinarily out of whack with reality. Mortgage rates have soared, almost tripling. Actually, you know what? I think they have pretty well tripled this year. So that makes a lot of folks unable to buy at current prices, which means prices have to come down. It also puts pressure on home builders, because there's not going to be the need for the sort of home building activities that we had seen during a period of relatively tight supply. Some of that tight supply likely had to do with folks buying 2 or 3 homes, trying to rent some, trying to Airbnb some, and a lot of that activity is likely to be subdued in a meaningful way. As a result, it's likely that we see lower prices, more supply, less demand. You do the math. I think the real estate market is in big trouble. It's not like other markets that we trade, because it's not liquid. I can't go and buy and sell a house in 5 minutes like I can a stock or a bond or a crypto token or any of this other stuff. But that means that there's just a lag effect in the housing market, right? So the drop in prices is likely to continue there. NFTs. There's just no interest anymore in these things. Volume has dropped 97% from its peak. I like to call them digital monkey JPEGs. They no longer enjoy wide appeal. The crypto winter, as it's called, where we've seen this prolific bear market where a lot of crypto has dropped 70% or more this year, is really undermining confidence and interest because people are wondering, well, if Ethereum or Solana or anything else this NFT is priced in, if they're going down in value, what's going to happen to the NFT? How am I going to sell it? What is its collectible value? And quite frankly, my opinion on this is most of this stuff has no value at all. It doesn't really convey ownership rights in most cases, and there's a high probability that you're not even getting a unique piece of art. It's mostly just driven by templates that have 3 or 4 or 5 different variables, like a different set of eyes, a different hat, a different mouth, and this is all done automatically by computers. It's not like an artist is making every single one of these. They're literally churning out thousands or even hundreds of thousands of seemingly unique but template-driven pieces of quote-unquote art. I think that this is sort of the Beanie Baby phenomenon of the 2020s. And I don't believe it's going to go anywhere that is a good place for collectors of NFTs. And I believe this drop in trading volume speaks to that. Last but not least, German consumers have a vote of no confidence for their economy. This is the lowest level, I believe, ever for this survey. And it is just absolutely staggering. But it makes sense. Energy costs are soaring. Economies in the Eurozone are softening, some heading towards recession. The ECB is saying they're going to continue to tighten. Whether that's true or not, we don't know. We are seeing some cracks in some of these European banks like Credit Suisse, which seem to be under increasing stress as they try to figure out what it is that's going to happen. Banks like that are so interconnected. They have an impact on other European countries. Even though they're Swiss, they have an impact on Germany. And Deutsche Bank probably isn't doing so great themselves. Are these the next Bear and Lehman? I don't think so, personally. I think Credit Suisse is in trouble, but I'm not sure that it's going to be comparable. There was a lot of talk over the weekend about how, this is the same as Lehman or their assets are even larger than Lehman, but they have a completely different composition of their loan book. They have a lot more corporate banking and a lot more exposure to other areas that are presumably safer. So I'm not necessarily looking at this as a Lehman moment, but I am looking at it as a left tail risk to be concerned about because at the end of the day, a lot of these banks interdepend on each other, and if one key player goes down, it can start to cause ripple effects. So that's it for Mayhem's Macro Monday today. I hope it's really helpful to everyone out there. I know I was trying to do these once a week. I got a little bit out of sorts with everything we've been doing at TraderAid. We've been trying to continue to build out our Discord, our website, and elsewhere. So if you're really looking for more of this type of content, talking about the macro picture, also a focus on fundamentals, on technical analysis, if you're looking for education, actionable trade ideas, and elsewhere, check us out on TraderAid.com. We've got 2 tiers. We've got one that's just the website, and we've got one that allows access to our Discord server. And our plans for just the website start at only $19.99 a month. So if you're new to investing and trading, or you just want to try to get a better edge, that's exactly what we're all about. We're building a community, an educational resource, a place where our team of experts can help many different people hone their skills so they can take control of their financial destiny. So thanks again for joining me. I'll be in touch real soon with the next Mayhem's Macro Monday.